your inventory decreases. So when you purchase on account, inventory gonna entry gonna be inventory to accounts payable. So this is purchase return. It is the opposite inventory, opposite entry. All right, guys. Now, journal entry to record purchases of 1,000 in merchandise is as follows. When you purchase inventory, what is the entry? Inventory to account payable. Simple. So if question is silent, automatically assume that inventory is on. Inventory is purchased on. If it is cash, then question will mention that cash purchases of 1,000. If question is silent, that a purchase of 1,000, automatically assume that it's going to be purchased on account. All right, because normal business operations are always on account, on credit basis, not always on cash. We are following accrual accounting, not cash accounting. All right, so if you recall from chapter 4, cash and cash equivalents, we talked about over there, cash accounting and accrual accounting. Now, the journal entry to record payment for merchandise within 10 days when discount rate is 210 net 30. What does it mean by 210 net 30? Can anyone tell me? You will be given 2% discount if you pay in 10 days. Otherwise, net amount will be paid in 30 days. All right. So you avail the discount. You paid within 10 days. So 2% you receive the discount. So how much? 1,000 value of inventory you purchase, 2% is 20. So how much your inventory? How much your inventory decreases? Only 20, because the payment or the cost is going to be negative, is less from the cost of inventory. So inventory cost is less than 20. So we decrease inventory with 20. Cash we paid 980, but our liability decreases because we are fully paid. We are fully covering the liability. So liability decrease. Liability decrease mean debit. Asset decrease mean credit. All right. So all the inventory discounts will be decreasing the cost of. Here we go. Here, remember, all the decrease in inventories will be decreasing the cost of inventory. So decrease in inventory is credit. Here we go. So we receive 20 discount. The discount decreases the inventory. All right, everyone. Now applying and compare various inventory cost methods. So this is costing method, not the inventory management system. Inventory management system, we are following perpetual inventory system. So many students, they are confused, sir, what is periodic and perpetual, and then inventory costing method, what is FIFO, LIFO, whether it is a separate system or not. No, inventory management system is whether it is perpetual and whether it is periodic. So, and then inventory costing methods are different, right? So there are two methods. I think, yeah, three methods. So let's just talk about this. So accounting methods affect the profit to be reported, income tax, and value of inventory. We'll talk about this when we, analyze the inventory costing methods. So choice of each method have effect on the financial statements and also on tax statements as well. So it means if we choose one method of inventory costing method, it has effect on our balance sheet, our income statement. Why? Because inventory will be written on balance sheet, cost of goods sold will be written on income statement, right? And profit has effect on our taxes. Higher the profit, higher the taxes. So any choice of our inventory costing method will be affecting our financial statements, both in income statement and balance sheet, and also our tax statements, right? Let's just talk about this. So what goes into inventory costs? So we just talk about this. All the things that we received benefits on purchasing the inventory will be less, and all the costs that we paid in addition to the cost of inventory will be added. So purchase price plus trade in plus any insurance, any taxes, less all the return, discount, allowances, anything. So that would be the cost of inventory. All right, we already discussed that. Okay, so there are 4 methods. Sorry, not 3, 4 methods. Specific unit method as well. So there are 4 methods of inventory costing. Inventory costing method. And the system is perpetual inventory system, right? Specific unit. Okay, let's take it after a break and then we start from here. All right. So we'll talk about each method after the break. Okay, class, welcome back after the break. We were talking about the inventory costing method. Number first is specific unit costing. Number 2, average. Number 3, FIFO, and number 4 is LIFO. So company can use any of these methods. Methods can have different effects on our financial statements and on income taxes. So specific unit method is used for businesses which have unique inventory. For example, furniture, antique furniture, especially automobiles and real estate, because every unit produced or every project produced or every jewelry produced is different, is unique. All right. So that's why, and here automobile industry. So we have different models, high-end models, luxury models, all right? So in that case, we use specific costing method. So business costs their inventories as specific unit of a particular unit. So if you understand the managerial accounting, so in that case, it is easy to find out their raw material costs, direct material costs, their direct labor and manufacturing overhead. So this inventory system is too expensive for inventories with common characteristics. If the inventory has a common characteristics, if they are making jewelry which is specific, same standards, same design, then it is very expensive, because for each jewelry you need to have a cost of each jewelry, and it is hard sometimes to find out, for example, how much light has been used on one ring if it is standardized. But if it is unique, then you can easily find out how many light has been used, how much labor has been used. But it is a common characteristic, a standardized one, and it's going to be hard. So this method is very expensive for those inventories which have common characteristics. Okay. This method is also called specific identification method. All right. So we are not going into details how to for the evaluation, because it is very easy. How much labor cost has been used, how much material has been used, and how much manufacturing overhead has been used. So it is very easy because everything is clearly provided. But the thing that makes it difficult is that you need to find out these 3 for each product. If you are making 10,000 unique product, then you need to have a costing of 10,000 units separately. So then the bulk of information and all the stuff is huge. So you need extra work or some specific software to do that, and they aren't free. Okay, so let's talk about the average method. Average method is used for those items who have common characteristics. Sometimes this is also called weighted average method. So as its name implies, this is the average one. Okay, this is the cost, total cost. This much unit has been produced. Just divide them. Simple. All right. So let's just talk about the valuation method of average inventory costing. So we have inventory. All right. We have the balance 10 units, and we purchase those 10 units at $10. And then we purchase number 1 and number 2, 25 items, 14 and 18. So it means there is inflation going on, right? Raw materials or things are going costly here. So you have a balance 10 units, and 10 was the price, so inventory cost 100. And now you find out you bought 25 units at 14, the inventory is now 350. And then you bought another 25, it costs you 18 per unit, and the total cost is 450 of buying 25 units. Now, how much is the ending balance? We have the ending 20. And how we find out this 20? Because 40 units have been sold. And how many units we have here? 60 minus 40 equal to 20. So now question is, how we are going to record, which costs we need to record on these 20, whether it is 10, whether it is 14, whether it is 18. We don't know. But we are following which method? Average costing method. So let's just talk about that. So every method, you add all the inventories with their costs respectively. So 100 plus 350 plus 450, answer is 900. And how many units you have? 60. So 900 divided by 60, what is the answer? $15. So what is the cost of units sold? You have sold 40 units. So cost of goods sold multiplied by 15. 600. Here you will write cost 600. And what is the ending balance of the inventory? 20 units multiplied by 15. So this one is very easy. All right. So in this case, you find out the cost of goods sold is average cost. The ending balance of inventory is also the average cost. This will go to balance sheet. This will go to income statement. So this is the T account for inventory. All right. So average costing is not a big deal. It's very easy. But does it make sense? In some cases it makes sense, but in all other cases it's very hard to find out the averages and